I'm up. Okay, live at 5, everybody. The ETF Think Tank happy hour starts right now. I'm Dan Weiskopf, the ETF professor, also lead portfolio manager for Block and the lead co-portfolio manager of Block, lead ETF strategist for the ETF Think Tank. Thanks everybody for coming. With that, I'm going to hand it off to Dave. Go for it.
How's it going, everyone? David Chikansky here. We haven't even started drinking and we're already messing up this show, but very excited for this week's guest. Chris is someone who we've all known for a long time, and as Dan mentioned, this will be an interesting look into the other side of the industry. That I'll pass it on to our founder, Mike Venuto.
Hey guys, Mike Venuto here, co-founder and CIO of Tidal and all the wonderful things we do at the Think Tank. Excited for today's show because not only do we have a market expert, but he's a friend. We do go fishing together as often as we possibly can. I had a little fun with
our wives will allow.
Yes, yes. We had a little fun with the ad for this show where Chris and I were fishing at ETF Exchange last year down in Florida, and he reeled in the most beautiful grouper, and on the way up, a tiger shark came out of nowhere and ripped it apart. So all we got was a head. So we're going to be talking about trading with sharks today. We love to have a drinking word or a celebration word, toasting word, whatever is compliant. Today it's going to be markets, as in market maker or what's going in with the markets or mark to market, wherever we go. So have a toast with us. I'm going to start promoting some folks up in a minute. Also, beyond being an amazing trader and market maker, Chris has just started a podcast. I happen to be the inaugural guest. I got to tell you, he's going to be the Howard Stern of South Korea. We did a podcast and we literally got 50 hits from Korean investors the next day on our website asking, what is this stuff that yields 50%? So pretty exciting things. Cynthia is on a train and will be here shortly, so we'll bring her in when she gets here. I just put a link to the podcast in the chat. The word is markets. Mr. Hempstead, go ahead and introduce yourself.
Thanks again. You've done a great job introducing me. Very flattering. So thank you, Mike. I've known Mike, David, Dan, the whole team at Tidal and Taroso for quite a number of years. Work closely with them in a market making capacity, in a portfolio trading capacity, in a seed capital capacity, doing custom rebalances. All of these roles and all of these ways that we've worked together with them and their clients, how we've become friends, how we've established relationships. They're all unique roles. Some firms do them all. Some firms do some of them. I've been a part of firms that do everything. I've been a part of firms that do some of them, but we're going to try and touch on as many of those, different maneuvers that people run in any day-to-day business. And that's what I'm at. So I'm currently been a couple of years here building out the desk that supports a lot of that here at Mirae Asset Securities, which is the U.S. broker-dealer for Mirae Asset Securities globally, which is a subsidiary, if some of you may be wondering, of Mirae Asset. Also owns an asset management arm of the business. They own some ETF providers in the US, overseas, and in Canada as well. That's a separate business. They're an affiliate under the asset management arm. We're on the securities arm. So we, look and smell like any other bank broker-dealer. We're not a bank, but we perform a lot of the same sort of services. So I'm a father of 5, husband of 1. I like to go fishing when I can. I don't get out there as much as I can, but I like to draw a lot of parallels in our business with people who do fish. So Mike and I can make a lot of correlations to our business, to how we approach fishing and, testing the water, the temperature, the wind, the tide, all of these things. There's always a million different factors to go into how we make decisions. When we do go fishing, I don't think our industry is very much different. And hopefully we get to, chat on some of that today.
Awesome.
Because the markets are dynamic.
Love it. So let's start with day-to-day what trading means, right? So I hear all the time, from the leaders of all these various desks, right? GTS and Jane and Susquehanna and BTIG and I was joking earlier about how, we went fishing last year during the ETF exchange. You brought your laptop and we're doing trades inside the cabin. And it was like, no, it's different for you. Like, you go all in on this. So I want to hear what's a typical day for Chris Hempstead at Mirae, because it's not just order taking, right? Like, I don't think people understand what trading really is when it comes to ETFs.
Yeah, so it's a great question, because like I said earlier, there's so many different flavors of it. And just to be clear, just to cover my bases here, I work with an incredible team of traders here at the desk. They are my friends and they are my partners and coworkers on the desk. And so when I log in, from anywhere I am, I do like to stay connected as much as humanly possible.
To be fair, he didn't do an actual trade. He was building an options ladder. We were talking. Sorry, I don't want to get you in trouble.
It's mostly monitoring, and just paying attention to what's going on. So, but luckily for me, usually when I do log in and I'm looking at the screens and see what's going on, I'm just watching everything operate smoothly. At least I hope so. Anyway, look, there's a couple of types of the ways that people, there's high frequency trading. There's people who trade Tesla, or they trade these penny stocks, or they trade on Robinhood, or they, there's so many. That's a different type of trading. That's trading. I would call that professional trading. People who are in, out all day long. They're trying to capture pennies or half pennies or quarter pennies. And that's a real business. There's a ton of volume in the US markets that trades like that. That's not what we do. There's also trading firms that accommodate a lot of that. There's trading firms, there's large wholesaling trading firms, three of whom are massive, 3 or 4, who try to consume as much of that business as possible by providing little increments of price improvement in the market to the quoted spread. Again, that's not what we do. We're more of what you would call a high touch trading firm. So we handle trade situations and trade needs for managers who have orders that aren't necessarily in such a hurry. A lot of our flow, if it's index-based, is tied to market on close. A lot of our flow, if it's index-based or if it's active and it's very large and outsizing the market, will be entrusted upon us or a firm like ours to put some thought into how we're going to execute that order and have as least amount of impact to the benchmark as possible, whatever that benchmark may be. And that could at times involve committing capital. It could at times involve using proxy hedges to try and minimize some of the risk. There's a number of different scenarios, but I like to think of our trading desk as a global portfolio trading desk. So automatically, when I say global, we kind of remove ourselves from a large number of broker dealers, because we do accept and trade and transact in over 40 countries, both emerging and developed markets, including the US. That is a difficult task. We can touch on that later because it involves a lot more market knowledge. The second thing I would say is I think where part of our sweet spot is that we do like the challenge of handling difficult orders, oversized orders, trying to find solutions with our client to minimize the impact on ultimately a benchmark. So it's not as sexy as the high frequency, write a book about them trading firms, but it's also not necessarily easy. It's the secondary market. It's a big marketplace. Say market again, markets, it's a secondary market. Means a lot to ETFs.
All right, David, I think you had the next one.
Yeah. So just what are your mornings like? What do you guys spend the first 2 hours before the market opens doing? And then also, can you explain what a heartbeat trade is?
Yeah. Okay. Well, that's a segue. But first off, why don't I explain what a market maker might do? What's different about an ETF or mutual fund or whatever? So the ETF trades on the secondary market. It's at the mercy of the quality of the market. So unlike a mutual fund, someone buys and sells, and they send their orders and their money directly in with the manager. They get net asset value. Everybody's happy. They don't even think about execution because there really isn't one as far as they're concerned. When you engage in an ETF transaction, even though you might be working with a manager, like Turoso or Title or one of their client relationships, even though you might be engaging in a manager's strategy, you're actually not trading with that manager. You're trading with some market maker on an exchange, and you're hoping that the quality of your experience when you're buying or selling that ETF, hopefully you're only buying, but you're hoping that the quality of your experience is good, right? You don't want to spend too much premium and discount and give away all of your alpha to market makers. So you want that market to be fair and orderly. This is the best I can call it. And I can assure you that most ETFs are quoted, if not the vast majority, gross majority, in a very fair fashion. The market making community in the United States is incredibly aggressive, fair, and competitive with one another. And people don't want to embarrass anybody. The markets are really, really high quality in the ETF market in the US. That being said, in order to achieve that, in order for the major market makers, you mentioned GTS, in order for them to achieve that, right, they have to come in early in the morning, sometimes overnight batches are running, and they're consuming the actual data for every single ETF that's published every single night. That's the beauty of transparency of ETFs. And so their computer systems will pull in all of the data, and they're going to do all kinds of things. They're going to be looking at the data, trying to figure out if there's been any changes, making sure that what they see makes sense to what they expected to see. Because if you only have a couple of hours to figure that out, and you're trying to figure that out in a few hundred ETFs, that's a lot of work. You've got a few hundred ETFs with hundreds, if not thousands of components of each one. And you're trying to make sure that, hey, listen, at 9:30, that bell's going to ring. And my relationships, the team at Title and others expect me to be out there making a bid and making an offer that is what I expect my clients to come into the market and experience in a fair way. So that process is really just reconciling what we call the NSCC file, or the portfolio composition file, of every ETF that comes to market. And we do it every single day. And if we find some inexplicable variation in it during that 2-hour prep time, if you want to call it that, that's the time of the day we're picking up the phone and we're chasing the custodial bank, the fund administrator, the portfolio manager, whoever we can get on the phone, the capital markets person, just to say, oh, look, there's a security in there that was acquired. Was that supposed to be cash? Or there was a stock split that doesn't look like it got picked up. Can we just assume that that stock split should be 200 shares and not 100 shares? Things like that. It's a lot of work. I'm not going to sugarcoat it. It's a lot of work. But that's pretty much how we spend our mornings. In addition to looking at the market and looking at our risk exposure and thinking, how do we want to be today? How aggressive do we want to be bidding, offering? Do we have skew? Do we want to be more aggressive or less aggressive? Those are also things that come into consideration. But first and foremost, we need to grow the highest degree of confidence every day before we post a market on an ETF. And that takes some time every morning.
Can you
on a good day,
define
it's quick.
aggressive? Can you define in further detail what do you mean we want to be aggressive on a day?
Yeah, so market makers, it's interesting. In an ETF that's rather new or doesn't trade a whole lot, there's not a lot of activity, there's not a lot of assets. Most likely, when you look at a quote, it's a single or maybe two market makers, and there really isn't much skew to it, I would say. But there are times where market making participants get very long a particular security or asset class, or very short. And for different reasons, one market maker may be long a particular asset class or type of exposure, and one might be short. That factors into how they may price those ETFs that have that similar exposure. In a real trivial example, imagine there were two ETFs that tracked short duration US Treasuries. And me as a market maker, I'm short $1 billion of that ETF, and another market maker is long $1 billion. As a short, you might think, well, why wouldn't you just create it and be done with it? But just assume for a second, we're not ready to create. We're going to still want to quote it all day long. So I can do one of two things. I can offer at a higher price because now I want to charge more to get short, and I can bid at a higher price because by bidding, I might be able to cover my short position at a lower price than it might cost me to create the ETF. So those are things that make sense to me. You know, like if my creation price is here, I might as well bid a little bit below that in the market because I'm actually short. I'm going to have to create at some point. And the market maker who's long might be thinking the same thing in reverse. I can redeem the ETF, but it's going to cost me some money to redeem. So why don't I offer it right up against that level where the redemption cost would be? And you know, that way, if I sell anything, it's just going to reduce my cost to redeem, and we're good to go. $1 billion is probably a bad example. Let's just assume it was like a couple of $1 million, because if it was $1 billion, you would create redeem. I'm realizing that as I'm saying it now, but that's why you might be more or less aggressive in an ETF as a market maker. If you have no opinion on the market, you can just assume that a market maker is going to be quoting that ETF or making bids and offers in that ETF that straddle what we call the arbitrage band. The arbitrage band is essentially our break-even cost to create new shares of the ETF and redeem existing shares of the ETF. That's our break-even cost. So trading at that exact price doesn't really do us any good. So generally, market makers will be a little bit outside of that. And when I say a little bit, we're talking about like maybe a bip or two, you know, but oftentimes it's even less than that, because again, you don't want to find yourself in a situation where you're quoting a product very, very, very wide, because you're going to find yourself answering the phone and people are going to say, listen, I can't get anyone to even look at this. The market's 20 cents wide or $1 wide. It'd be nice to sell everything really, really expensive to where you can create it and buy it really, really cheap, but it's not realistic. You wouldn't have many people asking for your help if that's the way you engaged in the market, because you're not really helping them that much. So it's not a perfect market. It's important for people to know the secondary in ETFs in particular, it's a perfectly inefficient market. And it's oftentimes seemingly perfectly efficient, but it's by definition, it's not necessarily a perfect market. There are premiums and discounts embedded in the market, and for good reason. But just, you know, sometimes they skew one way or the other.
So Chris, talk to us a little bit about what things impact the bid-ask spread, right? I mean, international markets are going to have a wider bid-ask spread when they're closed, right? Maybe, as an example, block has a wide bid-ask for other reasons, including maybe some of the names are highly shortable. So I don't know what the impact there is, although I have to say we tend to have a pretty tight spread. But what things impact the spread? And you know, obviously, if it's a $3 million ETF, the spreads could be
all right.
wide.
So again,
It's
a great question. I'll start with a trivial example. You have T-bills. T-bills are super liquid, super tight, very low risk. If you make an ETF full of T-bills, then you can probably assume that the market maker is going to be able to affordably make a spread at the minimum increment in the U.S. markets, which is a penny, and that's fine, and carry very little risk in doing so. The flip side of that is, if you were to make an ETF that was full of, I don't know, frontier market equities that are difficult to, and expensive to trade in countries with high taxes and fees, just expect that the spread in that ETF is going to be significantly wider than the spread of an equity ETF of mega cap US stocks, or the most highly active US stocks, whose spreads are all a penny wide and incredibly liquid. The reason is that arbitrage band I talked to is really what market participants and market makers are looking to define before they make a market in something. They're not just going to say, oh, it looks good. Now, that's the worst case scenario for any manager coming to market. That's the assumption that you're not going to have anyone trading your ETF. So what kind of market might I expect? The market a manager or someone bringing a product to market might expect, within the absence of natural buyers and sellers, is probably going to be indicative of the actual spread of the underlying portfolio, plus or minus a small, tiny margin, okay? Here's what happens in reality. You mentioned block, okay? The actual spread of the underlying portfolio in block, I'll pick on SPY. In SPY is meaningfully wider than the spread you'll ever see on screen. Why is that? You've got natural participant forces on both sides of the SPY market that drive that spread to the minimum increment, a penny wide or less in many cases, to a penny wide, because you've got so many buyers and sellers participating in the market that the actual need for a market maker is very, very low. It's very, very low. You know, market makers just like it's trading in the middle of the bid after the arbitrage band. Why do I need to get involved? There's so much liquidity. So when an ETF becomes, now what if an ETF became successful by way of market demand? I'll pick on bank loans for a second. So a decade or so ago, whenever bank loan ETFs started to come out, the ETFs were, the creation redemption cost difference was a bit meaningful. Let's say it was in the neighborhood of 15 or 20 basis points. But there was so much demand at the time that these products came out that I would say that 9 out of every 10 orders that came into the market was a buy order. So what did market makers do? They positioned their offers just above the price it would cost them to create the ETF. Okay. They weren't even thinking about redeeming the ETF because the buy to sell ratio was 9-to-1. So there was a massive amount of interest to sell these ETFs a little bit above the create price. And then all those participants were like, listen, there's no mathematical reason to bid a penny or two below that, except for the fact that if someone hits my bid, I'll probably just turn around and sell it anyway because the buy to sell ratio is 9-to-1. So because there was so much demand in products like that, you did find a product that should be 10 or 15 cents wide, actually only a penny wide. And that will happen with any ETF. It just becomes naturally busy. I'll pick on some of the, the 1 day to expiration ETFs that come out. I mean, some of those, the underlying spread is wider than the actual ETF itself. Why is that? There's a ton of demand for these things right now. A ton of demand. These ETFs are maintaining very nice tight spreads, but the creation and redemption band might be, a little bit wider than that. But there's so much demand for these products that, market participants can get in there, can make a tight market and not worry too much about it.
So Chris, should we be looking for, when we're looking at an ETF that trades 100,000 shares that's US based, 5 bip spread between bid and ask, 3 bips? I mean, just generally, I don't need all the details.
I think it's 5 or less generally, and 5 seems like probably a bit high for a US product that trades a fair amount. But yeah, it really depends. Remember, if you launch a product at $10 and it's a penny wide, it's a lot different than a $50 product at a penny wide. So it's just the math behind it. And that, again, we're driving down on it, but I think it's more important for people to trust and understand that if you ever want to get into weeds on the math behind it, there's people like myself and others that would be more than happy to pull up a spreadsheet and show you how it works and give you comfort. You're probably going to say, I get it, I see it now, and then you're not going to really worry about it anymore. And I guess without pulling a spreadsheet up and trying to earn your trust a little bit, markets are better than anywhere in the world, really, here for ETFs. And there's a number of things that drive that. When a product first comes to market, it arguably is probably the more expensive time to trade an ETF, but the markets are fair and they're right. It's the right market for these new ETFs. They wouldn't come to market without a good partner in there making a market. As they grow and as they start to trade more, the markets even become more efficient. They start to just become more and more efficient, and that's a wonderful result.
And then circling back before we go to Brittany, define what a heartbeat trade is, the benefits of it, and how the pipes work to execute on it.
Yeah, so a heartbeat trade, or what some people would call a CIB, which is CIB, custom in-kind rebalance. Negotiated trade is another. There's a number of different terms that people use. There is no official term. That term is coined from an article that was written a few years ago that it seemed to help people understand what the heck we're talking about here in the first place. But essentially what the 40 Act structure allows for is the in-kind receipt and delivery of securities to the trust. Most mutual funds don't engage in it because it's harder for them to manage in-kind in and out in a mutual fund structure, but the mutual fund structure allows for it. ETFs, it's almost all in kind, or if not, for the ones we're talking about with a Harpy trade, it would be all in kind. And what happens is the manager says, hey, look, I've got, a rebalance coming up. We're going to have to reduce some exposure here, increase some exposure over there. We've got low cost basis securities that are sitting in there that are coming out. We don't really want to sell them in the open market if we can avoid it, because we don't want to trigger the gain. We don't want to realize the gain. The gain's always going to be around, but we don't want to realize the gain right at that time. So what we'd like to do is get those securities out and somewhere else, and then replace it with the securities we're adding, and do that in kind, because the in-kind transfer of securities isn't a market event. It's not a trade in a sense. It's a delivery. And so what an authorized participant or market participant might do is create shares of the ETF in a standard fashion, and they will hold those shares for a period of time, assuming some risk really. And then ultimately they would be redeeming that ETF back in a custom redemption. And when they do that, the AP or the market participant will ask the manager, what are you giving me in this custom redemption? And not much to our surprise, they'll say, well, we're not going to give you back all 100 stocks that you used to create with. We're going to give you back these 5. So if it was a big trade, let's say it's a $100 million trade, you're going to get back, and if it's equal weighted on the redeem, you'll get back $20 million, each of 5 stocks, as opposed to what you created, which was $1 million each of 100 stocks. So you might be asking, well, wait a minute, how does that work for the market participant? What do they do? They're going to get back $20 million of each security that they've only delivered in $1 million. Well, if I'm perfectly hedged, right? If you assume that someone is hedged, well, then they would have to go out and sell $19 million more of each security. And all of the other securities that are not being delivered back in kind, well, they don't want to have any risk on there either. So they'll just buy those back market on close. And all of a sudden, the market participants out of the market, the fund has been rebalanced, and we move on to the next quarter. That was a really fast way of walking through it. I have a feeling that was probably a little bit complicated, but
no, you did great. You left out the part as to why it's good to the ETF investor, because that process eliminates taxes, right? Eliminates the ETF realizing gains on positions that are up, right? Like
I would say, I don't know what the legal way to describe it is, but like it eliminates the need for a distribution.
Yeah.
Right.
Which was another word we considered for today. We went with markets. If you were keeping up, you're on the floor at this point. So. But yeah, that was a great explanation. But the end result is a happy accident for the ETF investor that is pretty spectacular.
And the ETF investor, by the way, if the fund had been up, and if it was, I'm assuming it was, and that's why they're engaging in these kind of trades, there's still a gain in the ETF. The ETF owner, the ETF investor, still has a gain. They bought the ETF at 10 and it went to 20, and the manager rebalanced it in this way. There's still a gain there. If you sell your ETF shares at $20, you're still going to have a $10 gain. You got to deal with it. But what's not happening is you're not getting a distribution on the actual rebalance trades themselves. So those gains are still embedded in the fund. They just haven't been distributed out just yet.
Very clear. All right, Britt, you're up.
So my question kind of comes back to, there's a lot of different ways to execute an ETF because it trades on screen. So if I'm an ETF investor, there's different types of market orders. You can do a NAV trade. Can you maybe talk us through some of the different types of ways that ETFs are quoted and sold in the market?
It's a great question. I just had this conversation with someone recently who asked a very similar question. So I guess it's better to back away and look at the big picture of things. There's like 3,200, 3,300 ETFs in the US. By the time title's done, there'll be 4,000 by the end of the year. So there's a large number of ETFs in the market. Most of the ETFs don't trade a whole lot. So if you just look at the busiest ETFs, the top 500, top 750 ETFs, most investors including institutional investors. Okay, most investors, and even the bigger ones, institutional, ultra high net worth, block traders, can come into the market in those ETFs, those busiest ETFs that group up in the top quarter, or top 20%, I should say, and enter the market. They can use market on close, VWAP. They can ask for a block quote from their broker with an RFQ, which is called a request for quote. They can spread it out over the day. They can do percentage of volume. There's all kinds of cool little tricks they can use because there's so much activity in those funds. You can get a lot done and not impact the market. Okay, that's important. The question is how do you know if the ETF you're looking at fits that profile or fits the profile of the ETF that's ranked like 2,780 out of 3,200? It hasn't opened in 3 days, and the spread is, 2 or 3 or 4 cents wide, which is nice. That's the first thing. First test is passed. It's got a nice spread, but there's no volume and there's only 500 shares on each side of the market, and you want to buy 50,000. What do you do? What you don't do is probably the best way to start. Don't just put a market order out there and say, I sure hope they fill me on all 50,000 shares, even though they're only saying they're going to sell 500. You don't do that. What you could do is buy 500 and see what happens. Most likely, the market maker is going to sell 500 and repopulate another 500 at the exact same price. And then you could do that again, and you could do that again. You could do that again. And then the market maker might be like, what's going on? Someone's playing games with me. And then maybe they'll go to the next penny increment or whatever. And I wouldn't advise that either, but it's an option for people if they're bored. More likely than not, if you've got an outsized order in an ETF that falls into the category where it's clear as crystal, this is not a top heavily traded ETF, and I'm most likely looking for a market from a market making participant, the best course of action is to call your broker or your broker trade desk and ask them to reach out to ETF market participants and ask them for a quote. A quote meaning, tell me where you would be willing to buy and sell this ETF at 50,000 shares. Make them answer, and they will. They do this thousands of times a day on oversized orders. It's a new process for most people. They don't really know how to do it. So the best advice I could give for someone who's not in a position to ask for that, or they're not comfortable asking for it, is just make that first step. Call your broker, your advisor, and ask them, I want you to learn about how I would transact in bigger size, in less liquid, less volume ETFs, because I'm hearing left and right from industry participants that people do this. And I need you to learn how to give me access to that. And that's a fair question. And if your advisor can't answer that, and then you really need to challenge them to call up the chain, because I can assure you the block desks at Fidelity, at TD and Schwab, at Pershing, at LPL, at Raymond James, at Wells Fargo, Investnet, they know how to do this. They know exactly how to do this. So there is a process. I don't know off the top of my head who the call tree is, but that would be my best guess. And then a NAV trade. A NAV trade is also going to require that you ask someone to help you get that commitment from a market participant. It wouldn't be easy for mom and pop to come into the market and say, can I get a NAV trade on 1,100 shares of an ETF? It just would be, it'd be improbable. It's a difficult task. Can it be done? Yes, it's just seems like a lot of work. But if someone had a bigger size to do, a NAV-based execution is very much within arm's reach. Our desks like ours and a handful of others would be happy to make NAV markets. Do they give NAV exactly? It depends. Sometimes we can offer and buy ETF shares at NAV flat. But most time you can expect that it's going to be NAV plus a penny or minus a penny, depending on the cost of guaranteeing you that NAV. We have to think about our creation costs, our execution costs to hedge and all of those things. So. But again, it's a competitive market, and I think you'll find it's a very fair market. Did that help?
Can I just ask real quick as a follow? I mean, that is surprisingly manual. Like literally, is that the best way or the only way to do it? Because it's how it's always been done. You have to actually pick up the phone and call somebody, or could we, I don't know, innovate with some technology or something? Seems like very hands-on.
Well, it depends on where you're trading from. How are you, like, who's asking? So I'm making the assumption that that's an end user. That's not actually a button pusher or an operator of the trade. And so, yes, that's a manual process. But there are models that go off at Bank of America and InvestNet or Asset Market, whatever it is. There are models that go off that are automated. It just is like, it drops into this engine, the RFQs go out, and it happens really fast. Like, it's very, I want to say automated, because they're, even at the best market making firms, the biggest market making firms, if you come into the market and ask for $100 million or a $200 million quote on an ETF that trades, about $10,000 a day, it's more likely than not that that's going to be manual for them too, because it's an exceptional situation. It requires an extra set of eyes for a second. The good news is that doesn't happen 50 times a day. There are a lot of big block trades that happen every day. It just doesn't happen so often that you're not just going to automate everything, but you can automate a lot of it. So there are a lot of processes built at those wires and bigger retail firms. They have processes that when your order goes in, if it is above a certain percentage of volume, if it is a certain notional size, a certain share size, there are a number of rule sets that are built within these organizations that will trigger delivery to the block desk instantaneously without you picking up the phone. Okay. And then they know what to do with it. They'll see it. One of their traders will look at it and say, okay, I'm going to RFQ that out to the top 5 market makers, or I see an offer on the screen for the full size and it's a penny wide, so we're just going to get it done. So the good news is that depending on where you're set up, it may very much be automated and manual. But I was given worst case scenario. If it's not automated and manual, you got to challenge them to do it.
Is there a high correlation between good traders and gamblers? Is that something that it kind of seems like you're just going to make a market on anything? But I'll ask my real question is, what is an annual data bill like? And forget about the simple ETFs, for the more complex ETFs. I'm sure it's not as simple as this, but what is the ratio between number of traders on a desk and complex ETFs covered? Like, how do you see that?
All right. So we're a little bit different because we're more of a portfolio desk. We do some market making, but it's in a smaller scale than the bigger shops. But I think I know enough to cover some of the massiveness of the bigger shops, right? So if you think about the different types of ETFs that are out there, and number of names that they're making markets in. So the largest, most sophisticated market making firms are not just making markets in ETFs, they're making markets in stocks. They're making markets in options. They're making markets in futures. They're making markets in bonds. They make a market in a lot of things, right? And some of them they're really good at, and some of them they're okay at, and some of them they're maybe isn't their strength, but they're still out there. So when you think of the infinite number of possibilities that a particular ETF might present to a market making firm or an individual, if you were to break it down by its individual risk, it's a bit overwhelming. So what do? Most likely, and this is, again, I'm gonna dumb it down a little bit, but what they might do is say, okay, is this ETF all US equities? Is it all US dollar denominated underlying securities? If so, or is this bunch of ETFs all US? Put that in one bucket. And let's take that bucket and break it up into large cap, small cap, mid cap, micro cap. I don't know. Let's just do it. Let's just slice it all up. Let's break it up into ETFs that have swap, ETFs that have short exposure, ETFs that have option overlays. Like, I'm already just talking about US underlying ETFs, and I think I've just explained like 6 or 7 or 8 different buckets that you could add into the complexity of how are we thinking about making markets. Leverage. Is it leveraged long? Is it inverse? Is it leveraged inverse? Like, these are all fair ways to approach the market. And each different bucket that we create has slightly different rule sets when it comes to risk, when it comes to hedging, if that's what you choose to do. Now add in international markets. Now you've got developed markets, you've got emerging markets, you've got frontier markets, you've got some that settle on Euroclear, some that don't. You've got T1 settlement securities in some countries and T2 in others, and even T3 in some. It's a massive amount of computing and organizational skills to get it all right. That's the bad news. The good news is the computing power in the world today is as fast and as amazing as it's ever been. And so, you know, technology and I would imagine forms of artificial intelligence and just the speed of computing has allowed for these really brilliant market making firms to create processes so they can compartmentalize every different situation that hits them. I would imagine that the data and technology bill at the largest, you know, market making firms, some of the, you know, 3 or 4 or 5 of them that we may know offhand is mind-bogglingly high, right? But I would imagine they wouldn't pay that bill if they weren't getting a return on that investment, right? Why would they be paying a huge technology bill if it was providing no return? So
Talking 7 figures though, is this an 8-figure?
oh God, I would,
like,
yeah,
like, give
I
us
mean,
like
I don't have any
comma
proof, but
range, like
I would say you'd be lucky to build a process like that for 7 figures. But
data.
you know,
Yeah.
I would imagine that just the number of trades that they're processing, the number of strategies, the amount of risk that they take, the number of combinations of just you're talking in the, you know, hundreds of millions of data points in very short periods of time that are being consumed and processed. It's I couldn't imagine what the number. I will embarrass myself and say a number because it's probably extremely high. But again, take it into consideration as to what is the world getting from that. This investment that they've made in technology and risk and market making and risk taking, you know, this investment that these firms have made has given us, the consumers, the most efficient market in the world. I mean, they're talking about sub-penny execution markets now, and there's a little bit of pushback on that. There's an industry, you know, give and take on that. There's difference of opinions on whether or not it's needed, and you know, what does it really mean? And there's all kinds of rules that we're considering. But there's the good news is there's not one firm that does it. There's several. And I mean several. There's, you know, it's not hundreds, but there's several firms that invest in this kind of concept, in this mentality, and that's the great news. So there's competition out there, and the rest of us, you know, we win to it. Now they take a lot of risk and they invest a lot of money in technology and data, but I would imagine these firms are getting a good, healthy return on that. Otherwise, they wouldn't be doing it. Good for them, you know.
So Chris, I don't know that you're still in this area of the business, but you did me, frankly, a huge favor, and you know I'm still grateful for it, for helping me launch Menu, right? And I still appreciate that. And the hardest part about bringing an ETF to market using our analogy is, well, I thought I had a whale, right, with the idea. It turned out to be a guppy, but you know, talk to us a little bit about the process on launching an ETF, if you would, and you know what the market making side is thinking, because clearly cost of capital is way different today than it was in 2016.
Oh yeah. So a couple of things have worked in our favor. So back in 2016 this is before 6C11. So ETFs really came to market in 25,000 and 50,000 share increments for minimum sizes. We've now seen ETFs come to market 5,000 share increment sizes. It's reduced some of the cost friction for market makers to seed ETFs and hold inventory for the early days of an ETF. That was a big complaint because there were so many ETFs coming to market. Balance sheet, even though it was cheap, was still, because balance sheet was cheap, everybody wanted to use it for different strategies. They didn't want to just sit on seed capital. So that was one thing. So that some of that friction has been reduced, but it's an interesting time right now. We have so many ETFs coming to market with options overlays and things along those lines, and option strategies and all of that. And it just seems like there's an infinite number of ETFs like primed and ready to come to the market. And so that's a little bit overwhelming to think about, because do we have the capacity as a market making community to support all that? Do we have the capacity as a seed capital community to support it as well? So with respect to seed capital, and we can talk about Menu or anything else, when you have an idea like that, you're coming to market, you're going to tap on a few doors of market making participants. and see capital providers and say, do you have interest in this? Is this something that interests you? Is this something you have capabilities in? Really, that's what you really know. You want to know, are you capable of supporting this? If the answer is yes, we are capable of committing capital to this product, and we are interested in learning why you think we should care. Right? What is it about this that you think is exciting? Are you going to sell it? What I mean by that is, what we're going to ask as market participants is, what's your post-launch plan? Like, is it just me putting $1 million of seed in and then you're hoping that people find it? Because if that's the answer, doesn't mean you're not going to get a respondent. It just probably reduces your likelihood of finding one fast. And the reason is that because capital is expensive, especially now it's over 5% right now. So you've got now you're asking someone to commit capital on an ETF, hedge it with a short position, fund it on the hopes that people find it and start buying it. That's a big ask. So most ETFs coming to market nowadays will come to market with, I don't want to call them angel investors, but there's indications of interest, indications that people will be interested in buying this ETF. You might have a whale saying, look, if this thing was in an ETF, I'd probably buy it. In which case, gives you a high degree of confidence. Chris, don't worry about it. You can seed it. You should be out of your seed in the first week. We have high degree of confidence you'll be out of your seed quickly. And look, as market makers, we kind of have to take you at your word. It's really what it comes down to. There's no guarantees. We can't know anything ahead of time. So we just kind of assume that you wouldn't be spending all this time and money launching an ETF if you didn't have interested parties asking for it. Most of the time, the gross majority of the time, the money comes and it's out. It's been spoken for, and it's been and I think part of that is a combination of the market making community complaining for a long time about sitting on stale positions, and at the same time, the issuing community getting really, really, adept at conveying that message to their clients and saying, don't launch unless you have a plan for post-launch. What's your distribution plan? Who's going to be buying this fund? Right? Don't put it all on the market maker. And Menu is, but there are so many examples like Menu that came to market, didn't do what the early wish was, and then all of a sudden, by some sheer luck, took off. Like it's incredible. What is it one that the pandemic put life into jets? It just did. It was an airline ETF that just wasn't doing a whole lot for a long time. And I know those folks pretty well, and they're the nicest team. They're really great. And the ETF was kind of, it was just kind of like rolling along. It was kind of boring.
There's also the guys who like close right before their moment of time, like the Goldman Sachs short interest ETF, closed right before GameStop. Like that probably would have been $1 billion ETF.
It's timing is really weird. So there's timing, and there's stamina, and there's luck, and then there's just fate, but there's all these things that contribute to the success and failure in ETF. Most of the ones I just listed, you don't want to rely on. You don't want to rely on timing, luck, fate, stamina, because those are all things that keep you up at night. What you want is sound distribution. What you want is people telling the story, whether it's boots on the ground, knocking on doors, whether it's officially like wholesalers all over the country, whether it's digital print media, something to convey the message, getting on CNBC or Bloomberg TV and talking about your strategy and getting people interested, dropping it into a webcast that might be broadcast in other countries. I don't know, these are all, none of these are bad ideas. They're all just, they're efforts, and you want to see flows. Look, as an asset manager bringing a product to market, you get paid on assets under management, right? And so having an ETF with a little bit of assets earns you a little bit of money and probably doesn't cover the cost of keeping the ETF open. So we don't want that. Nobody wants that.
Brittany, do you have a second question?
Yeah,
Go
but
for
it's
it.
not on that same thread.
It's fine.
My question is, so I came from the AP side of the world, and I think a lot of times people use AP and market maker in the same vein. Do you maybe want to help dispel if there's any differences and thinking between running an AP or being a market maker and what some of the risks are in each of those businesses? You guys are both, I believe.
Yeah, so they are very different. And I'm so glad you brought it up because it is important for people to understand. So the authorized participant is really the entity that has the license, if you will. If it was like a little driver's license or something that allows, as a clearing agent, to create and redeem ETF shares directly through the trust. Okay. Market makers aren't necessarily self-clearing. They may prime at a large global bank, A or B, right? And that large global bank, as a service to its prime clients, will have AP agreements with various ETF trusts. And the clients of those banks can use those AP agreements because what's really happening is the authorized participant is creating and redeeming ETF shares with the trust on behalf of their clients. Market makers, market participants, hedge funds, even for that matter, can get access to the create redeem functionality. But also, oftentimes, an authorized participant that's self-clearing, like ourselves, can also be a market maker, right? There's one of the largest market makers in the world, not us, but one of the largest market makers in the world is also self-clearing. And so they don't need to use this. They have their own AP agreements, right? So they make markets and they're an AP. But oftentimes the market making function is a unique role, and the AP role is a much. I usually say the market making function is in the secondary market. It's where the trading happens. It's where the risk is taken. The AP function is how the market makers unwind all of that risk. It's how they manufacture the shares that they owe for the buyers that they sold to, or it's how they destroy the shares that were sold to them that the sellers didn't want anymore. It's a back office function, truly. Now it carries with it operational investment, operational risk, as you know, Brittany. It's a process. It's not as sexy and exciting as being the market maker, but it's a very necessary part of the ecosystem. And look, I mean, for me, it was easier to build that out here before market making because we are self-clearing entities. So it was very, for me, a clear vision to say, let's start with global portfolio trading and authorized participant services, and we can migrate over to market making, in that after we've got all that set up, because I would need all that infrastructure set up anyway, right? So a great question. We get it a lot.
She's our ringer, by the way.
Yeah. We've spoken.
I'm not surprised.
Should we go to more complex stuff now, since we've put everybody through all the complex?
Oh, everything
trading.
we've talked about has been simple.
Yeah. I'm gonna go there anyway. So one of the things that I would say has been a theme for the last year in the ETF industry is more and more complex product, right? A lot of people say the ETF rule, they call it 60-11 for anyone who needs to sleep, changed the market. I actually think it was the derivatives rule, 18F4, that brought leverage, that brought options, that brought derivatives, that brought swaps to the ETF world in a totally different way and broke up what was essentially a monopoly. But that shit ain't easy for market makers, APs, any of you guys. Like, the trend, without a doubt, has been more and more complex product. I mean, is it just that there's so much juice in them that it's worth it for you guys to do it? Or
no,
what is it doing? What is it doing for you guys? Yeah.
All right. So, So first of all, it depends on who you're asking. So when we say this is complex, it's probably because we haven't looked at it. Really, at the end of the day, someone brought to me a strategy. No one will talk to me on this ETF idea. No one. I can't get anyone to pick up the phone. I said, why is that? He goes, well, I start talking to them about it. They all glaze over and say it's too complex, and they hang up the phone. So why is that? Tell me about it. He's like, oh, it's a multi-product managed future strategy. Like, what kind of futures? He's like, every future you can think of. It's like, okay,
so Jerry Parker.
So the bad news is that the reason why participants will immediately push back is they're like, I've got so many different ideas coming at me. Like, that's just going to take time for me to break down and figure out how to make it easy. It's all it comes down to. Most of the ETFs that come to market that are seemingly complex are actually not. They just take a little more time to get normalized and get comfortable with. So most market makers, a lot of market makers might look at a, 1 day to expiration ETF and say, that's complex. I don't want to deal with that. I can't figure that strategy out. It's just, yes, you can. If I can figure it out, they can definitely figure it out. These are PhDs, right? Like, I am not a PhD. So if the product isn't a plain vanilla long equity, US equity underlying ETF, but it has puts and calls, and it's got futures, it's got some swap in it. Of course, it's complex relative to a plain vanilla index fund, but it doesn't mean it's impossible. So I say you just have to approach it a little bit differently and try to put a carrot on a stick and say, I need you to really take a look at this, because we don't think it's as risk complex as it looks. We actually think it's a lot less risky than it looks. Here's why. We don't think finding a cost affordable hedge is going to be difficult, and here's why. So as a market maker, even though the underlying securities look and smell complex relative to plain vanilla equities, the risk exposure isn't. Ultimately, that's what we need to solve for, right? At the end of the day, we could put extremely complex things into a wrapper, but if it's not complex for me to hedge it, or to mitigate the cost of providing a market, at that point, as a market participant, remember, market makers and market liquidity providers are not necessarily investors. They're not. Our job is to turn over our balance sheet and provide liquidity. Our job is to be in the market all day, every day, and just create inventory when it's needed and destroy inventory when it's not. Our job is to clear the shelves and load the shelves, and clear the shelves and load the shelves. That's our purpose in the market. You, me as an individual, and all of us as individuals are investors. That is, our job is to buy and hold, right? So complexity is in the eye of the beholder, or the person asking, and it's how they ask and how they deliver. But I've tried to make a habit of not falling into the trap of saying that's too complex before I've really given it a good look. And I've certainly found myself looking at something and thinking it's complex, and in reality, it is complex because it's expensive. That's really what it comes down to. There's a price to everything. Everything has a price. So if it's so complex that it creates a wide price band for me to get comfortable making a market in it, okay. I mean, it's actually not complex. It's just really expensive. And I think that's what you're looking to avoid, is that level of complexity is going to create cost. But if you create something that's complex, but it doesn't carry with it a high cost of market making and things like that, then kudos to you. It means you've conveyed that message to a market participant, and you've given them comfort that they can do it. But there are more products coming, and I think it's going to be a lot more. Look, the buffer products. Okay, buffer products are complex. I worked at a major global bank when they first came out, and I was seeding them. And the answer that the derivatives team gave me was, why? We get it, but why would we support this? We write products on this. This is what we do. Why would we support an ETF? I'm like, well, I don't know. Let's see. ETFs are more popular than your products are, and they tend to raise more assets. These are going to be more tax efficient. There's all, I can give you 100 reasons, but I'm asking you as a favor, because I'm not a structured product expert. Can you lend your support to this? I'm going to seed these ETFs, and I need you to solve for these complex option strategies every single day.
Are they like shaking in their boots? Are the structured products people just like, oh my God, do they see the writing on the wall with all of this? Like,
well, this particular bank is out of business. So, well, the bank's not out of business, but they shut down that whole division. So no, they're probably kicking themselves and saying like, all right, we missed that one. It was right over the plate, sitting there, take it. You can be the first hero of this ETF structure, but it wasn't big enough for them to keep their eyes on it. So they all went in another
Or the
direction.
fees are too big on, I think it's often the fees are too big on the other side of the fence that they're like, why would we want to do that? You know, like, I mean,
Because I think the reason is because these structures exist in a lower cost, more tax efficient ETF model that you can charge all the fees you want on the old structure. You're going to lose your assets over time. So you'll be charging a high fee on a lower asset as opposed to charging a fair fee where the money's going. But there's so many products coming to market. It's just, the option stuff alone is just, it opens up a huge opportunity for new product ideas coming to market. Think of every ETF that doesn't have options on it now probably will as a new ETF, like the one with options and the one without, I think we got to, and there's a ton of managers out there, hundreds, if not thousands of managers out there who have no ETF in the market. And the bar to entry right now is so low, they can literally just, they can come to market. They can work with someone who knows how to do it. Someone like you guys who knows how to get the product to market, get them in there. They don't have to know, they don't have to be an expert at all this stuff. They just know that they have coverage and they can get to market quickly with their name on an ETF. And
just call Saul. Title.
As long as they have a distribution, a post-launch plan, right? Chris, we're gonna wrap up. It's 6 o'clock. We appreciate that you're always willing to take the call and look at a complex product and give it time. That's why you're one of the good guys in this business, and we love you, man. And thank you everybody for joining us this week. And we will see you next week. I think we're between two potential guests, right? Weiskopf, I don't think we've confirmed the guest for next week. So let everybody know. Thanks everybody for joining. Thanks, Chris. It was a great show. We'll see you.
Thank you so much. I really enjoyed chatting again. Thanks, Cynthia and Dan, the whole team. Thanks for the questions and the confidence. Thank you so much.
Thanks,
Have a
Chris,
good
for
night,
being available.
everybody.
Thank you.
Bye.